I'm about to show you why the 8% dividend stock you think is making you rich is actually making you poor, and I'll prove it with math you can verify yourself in the next 15 minutes. Here's the real question. Would you rather have $500 a month in dividend income starting today, or $2,000 a month 15 years from now? Because that's not a hypothetical. That's the actual trade-off between high-yield dividend investing and dividend growth investing. And here's what almost nobody tells you. The strategy that feels like it's paying you more today will leave you with less wealth, less income, and more risk in the long run. I'm going to show you 3 things in this video. First, the hidden math that makes over 15 years a 3% today dividend more profitable than an 8% dividend. Second, the real-world examples that prove it, including one comparison that will completely change how you think about yield. And third, exactly which strategy fits your situation, whether you're 25 or 65, because getting this wrong could cost you hundreds of thousands of dollars over your lifetime. I'm going to keep this simple, visual, and data-driven. Let's dig in. So let's start with why high-yield stocks are so damn tempting. You're scrolling through your brokerage app. You see a stock paying 8% dividends. Maybe it's AT&T. Maybe it's a real estate investment trust. 8%. Your brain does the math. If I invest $50,000, that's $4,000 a year. Every quarter, $1,000 just shows up in my account. That's a car payment. That's a vacation. That's real money. Now compare that to a dividend growth stock, Johnson & Johnson, Visa, Procter & Gamble, paying 2.5% to 3%. On that same $50,000, you're only getting $1,250 to $1,500 a year. It barely feels like anything, so naturally, 90% of beginners chase the 8%. It's human nature. We're wired for immediate gratification. That high yield feels safe. It feels profitable. It feels like you're winning at investing. But here's what I learned the hard way in 2019 when I loaded up on high-yield REITs right before the interest rate spike. That 8% dividend, it's a snapshot. It's one frame in a very long movie. And when you watch the whole film over 10, 15, 20 years, the ending is completely different than you expected. Let me show you the math that changed everything for me. The game changer is one concept. Dividend growth rate. High-yield stocks give you a big number today, but that number stays flat. Or worse, it gets cut. Dividend growth stocks give you a smaller number today, but that number increases 6%, 8%, even 10% every single year. And this is where most people's brains break, because we're terrible at understanding exponential growth. So let me show you the most powerful example I've ever seen. The Visa versus Verizon showdown, 2008, Visa dividend yield, 0.2%, basically nothing. Verizon dividend yield, 5.6%, huge income. If you invested $10,000 in each, Verizon paid you $560 that year. Visa paid you $20. Verizon wins, right? Not even close. 2023. Here's what actually happened. Your $10,000 Verizon investment grew to about $20,000. Decent. Your $10,000 Visa investment grew to roughly $100,000. Same starting amount, same 15 years, but Visa gave you 5 times more wealth. This is what I mean by the movie versus the snapshot. Visa grew their dividend at 22% per year for 15 years. That compounding turned a tiny income stream into exponential portfolio growth. Now here's the really interesting part about income. By 2023, Verizon was paying you about $730 per year in dividends on your original $10,000 investment. That's a 7.3% yield on cost. Not bad, but here's where it gets crazy. Even though Visa's yield on cost was lower at around 4%, you had so much more wealth that you had real options. If you needed $730 in annual income like Verizon was generating, you could sell less than 1% of your Visa shares once and generate that same cash while still having a $99,000 portfolio left over. Or you could just hold everything and enjoy your $400 per year in growing Visa dividends, knowing your net worth was 5 times higher. That's the power of total return thinking. Income is nice, but wealth gives you options. Okay, so Visa is an incredible example, but you're probably thinking, how do I find the next Visa? How do I know which companies will actually grow their dividends? This is where the dividend aristocrats come in. These are S&P 500 companies that have increased their dividend every single year for at least 25 consecutive years. Let me paint a picture of what that actually means. Johnson & Johnson has raised its dividend every year since 1962. Think about what they survived. The 1973 oil crisis, Black Monday, 1987, dot-com crash, 2000, September 11th, the 2008 financial meltdown, COVID-19. Through all of that, recessions, wars, pandemics, market crashes, they raise the dividend every single year. That's not luck, that's a business fortress. And here's the data that shocked me when I first saw it. From 2005 to 2023, Dividend Aristocrats as a group returned 11.2% annually. High-yield indexes returned 7.8% annually. And aristocrats did it with 15% lower volatility, higher returns, lower risk. That's the holy grail. Why does this work? These companies have payout ratios under 60%. They're only paying out about half their earnings as dividends. The rest gets reinvested into growth, innovation, competitive advantages. Compare that to high-yield companies paying out 75% to 80% of earnings. They're maxed out. No room for error. When earnings drop even a little, the dividend gets cut. Quick question for you. Are you holding any high-yield stocks right now? Drop the ticker in the comments. I'm genuinely curious what you're invested in. I might even make a follow-up video analyzing the most common picks. Alright, here's the secret weapon that makes dividend growth unfairly powerful: tax-efficient reinvestment. Most people think about dividends as income you spend, but that's not how you build wealth. Here's what the wealthy do. They reinvest every dividend payment back into more shares. Automatically, let's say you own 100 shares of a dividend growth stock paying $3 per share annually. That's $300. You reinvest that $300 and buy 3 more shares. Next year, your dividend grows 8%. Now, you're getting $3.24 per share on 103 shares. That's $333.72. You reinvest again. Buy more shares. Year after year, you're buying more shares, and each share is paying more dividends. Over 20 or 30 years, this becomes exponential growth, not linear. Exponential. And if you're doing this in a tax-advantaged account, IRA, Roth IRA, 401k, ISA in the UK, you're not paying taxes on those reinvested dividends. So 100% of that growth compounds. Here's the comparison. A high-yield stock paying 8% with 0% growth gives you the same $800 every year on $10,000. After 20 years, you've collected $16,000 in dividends. A dividend growth stock paying 3% with 8% annual growth. After 20 years, you've collected $31,800 in dividends, nearly double, and your shares are worth significantly more. That's the difference between good and wealthy. For those of you in your 20s or early 30s, this is your biggest advantage. You have time. If you start now with dividend growth and reinvest for 30 years, you could realistically build a portfolio generating $50,000 to $100,000 in annual dividend income. That's retirement-level passive income. Now, let me show you what just happened in the real world that proved all of this. Between 2022 and 2024, interest rates went from basically 0 to over 5%. The Fed was fighting inflation aggressively, and something brutal happened to high-yield stocks. REITs dropped 20% to 30%. Business development companies got crushed. High-yield dividend ETFs lost 25% of their value. Why? Because if I can get 5% in a savings account or a treasury bond with 0 risk, why would I buy a stock yielding 6% or 7% that could cut its dividend or lose 20% of its value? I wouldn't. And neither did anyone else. So those stocks tanked. Meanwhile, dividend growth companies, Johnson & Johnson, Visa, Procter & Gamble, held up way better. They have strong balance sheets, less debt, less sensitivity to interest rates. But here's the part that really matters. Inflation was running at 3% to 5% during this period. If you owned a high-yield stock with a flat 8% dividend, Your real purchasing power was only growing at 3% to 5%. You're barely keeping up. But if you owned a dividend growth stock raising its payout at 8% to 10%, you're beating inflation by a mile. Your income is growing faster than the cost of living. That's real wealth protection. This is why Morningstar, JP Morgan, and S&P Dow Jones indices all say the same thing. Focus on dividend growth and sustainability, not the headline yield. But even knowing all this data, most people still chase yield. Why? Because the human brain is wired for instant gratification. Behavioral finance calls this present bias. We overvalue immediate rewards and undervalue future rewards, even when the future rewards are mathematically better. This leads to what's called the yield-chasing trap. You see that 10% yield and your brain screams, free money. But it's not free. You're taking on risk. You're accepting volatility. You're betting the dividend doesn't get cut. And that bet fails more often than you think. A T&T, the cautionary tale. For years, AT&T was the poster child for high-yield income investing. Steady telecom, reliable dividend around 7%. Then in 2022, they cut the dividend by 47%, almost half. Gone. Imagine you're a retiree. You've built your entire retirement income plan around that AT&T dividend. You're getting $14,000 a year from your AT&T shares. Then overnight, it drops to $7,400, and the stock price fell 30%, so you can't even sell without locking in a massive loss. That's the risk of high yield. It's not theoretical, it's real, and it's painful. Dividend growth investors don't have this problem. They prioritize quality and consistency. They're willing to start with a lower yield because they understand compounding. They're emotionally resilient during downturns because their income keeps growing, even when prices dip. So here's the big question. Which strategy is right for you? Let me break this down by situation. You should focus on dividend growth if you're under 50 years old with a 10-plus year time horizon. You want to build long-term wealth. You care about inflation protection. You can reinvest dividends and let them compound. You want lower volatility and risk-adjusted returns. You might need high yield if you're retired or semi-retired and need high cash flow right now. You have a large nest egg, $500,000 plus, where even a 5% yield covers your expenses. You fully understand the risks and are highly diversified. You're comfortable with potential dividend cuts and volatility. For most people watching this video, the answer is clear: dividend growth. But here's the secret almost no one talks about. You don't have to choose just one. The blended strategy. Build a core foundation of dividend aristocrats, companies yielding 2.5% to 3% with 7% to 10% dividend growth. That's 70% to 80% of your portfolio. Then add 20% to 30% in moderate yield stocks, companies yielding 3.5% to 4.5% with stable 5% to 6% growth. This gives you meaningful income today while maintaining the compounding power that builds real wealth over time. Let me bring this all home. The question isn't dividend growth versus high yield. The question is, do you want to feel rich today or actually be rich tomorrow? Because the data is crystal clear. If you want maximum wealth, inflation protection, and long-term income that actually grows, dividend growth wins. It's not even close. But if you need cash today and you're willing to accept higher risk and lower total returns, high yield can work. Just know exactly what you're trading away. Here's my challenge to you. Stop chasing the highest yield. Start chasing the highest quality. Look for companies with 25 plus years of consecutive dividend increases, payout ratios under 60%, strong balance sheets and competitive advantages, track records of growing through recessions. Because in 15 years, that modest 2.5% yield today will be an 8% to 10% yield on cost. Your quarterly dividend checks will be 3 to 4 times bigger. Your wealth will have compounded, and you'll look back and realize that patience and discipline were the real secrets all along. That's the power of dividend growth. That's the power of letting time and compounding do the heavy lifting. If this video changed how you think about dividends, do me a favor, hit that subscribe button. We break down investing strategies like this every single week, and I don't want you to miss the next one. And drop a comment right now. Are you team dividend growth or team high yield? Tell me what you're currently invested in. I read every comment and I genuinely want to know your strategy. Thanks for watching. Now go build some wealth. I'll see you in the next one.